Okay, let's dive right into this explainer. Today, we're exploring the actual mechanics of a stock exchange, and we're going to evaluate the highly anticipated National Stock Exchange IPO. The NSC is gearing up for what could honestly be a historic public listing, and it's drawing massive attention from everyone, retail and institutional investors alike. But, to truly grasp the weight of this event, we have to look way past the daily ticker tape and understand the actual engine running underneath it all.
So here's how we're going to systematically break down this financial powerhouse today. First up, owning the marketplace. Then, how the exchange profits, the capital market moat, the unlisted price and valuation, and finally, a reality check on the risks. Section 1. Owning the marketplace, which is a total paradigm shift. We're kicking things off by completely shifting how we typically view stock market investing.
Think about it. What if you could own the marketplace itself? Usually when we participate in the financial markets, we're constantly stressing over picking winning equities or mutual funds. But this opportunity requires a completely different perspective. We're looking at the infrastructure-led transactional model. Basically, it's like buying the casino instead of playing the games. You aren't betting on a specific company's product launch or their quarterly earnings. You're investing in the very platform where all those bets actually take place.
Think about your typical market participant. You face inventory risk, portfolio volatility, shifting consumer habits, the whole 9 yards. But as a market infrastructure institution, the exchange literally doesn't care if the broader market goes up or down. It just acts as a financial utility, raking in a fee on the sheer volume of participation. It's a completely different ballgame.
Section 2. How the exchange profits, looking into their core revenue engine. Now you might be wondering where all that money actually comes from. Let's look under the hood.
Digging into the exact breakdown of their massive income for fiscal year 26, a staggering 76% of their revenue comes directly from transaction charges. They levy this nominal fee for every single buy and sell order executed across cash equity, derivatives, and commodities. When average daily traded values just soar, like equity derivatives hitting over 1,000 crore rupees in daily premium turnover, this transaction engine essentially prints revenue.
But, the story doesn't end with just transaction fees. Beyond basic trading, the exchange has built these highly predictable, recurring secondary income streams. They charge initial and annual listing fees to companies raising public capital. They charge institutional firms some pretty hefty subscription fees just to place their servers inside the exchange's data centers for ultra-fast trading. Plus, they license their benchmark indices and market data to analytics platforms. The whole shebang is a wonderfully diversified ecosystem.
So, what's the big takeaway here? This incredibly asset-light business model translated into an enormous consolidated net profit of over 10,300 crore rupees in fiscal year 2026 alone. To put that into perspective, because they don't need massive physical capital investments to scale up, a huge chunk of that top-line revenue flows straight into the treasure chest.
Let's move on to Section 3, the capital market moat, covering network effects and margins. In the business world, a moat protects your castle from competitors. And the NSC has built an absolute fortress.
To really grasp this, we have to talk about the network effect. Because the NSC hosts the highest liquidity, it naturally attracts the most institutional flows and trading members. This immense depth means much tighter bid-ask spreads for traders. And guess what tight spreads do? They attract even more volume. It creates this sticky, self-reinforcing cycle that is incredibly hard for any new competitor to break into.
That network effect, it has propelled the NSC to an absolute dominant position. They hold a commanding 93% market share in India's cash equities. 93%. It completely dwarfs its competitors in scale and volume, making it the undeniable primary proxy for India's structural shift toward financial assets. And because their core tech infrastructure remains relatively fixed, scaling up those trading volumes leads to massive operational leverage. Basically, when more trades happen, the cost to process them doesn't really go up proportionally. That insane efficiency is perfectly demonstrated by their staggering 67.7% EBITDA margin in FY26. That is just huge. With numbers like that, it's absolutely no surprise that retail investor sentiment is incredibly bullish right now. Online communities view this consistent 3-decade growth as an opportunity on par with some of the legendary wealth creators. They see an expanding middle class, booming demat account openings, and they recognize the NSC for what it is, a mature, highly profitable fintech monopoly. All right, Section 4, Unlisted Price and Valuation. We know it's a great business, but to objectively evaluate this opportunity before the IPO, we have to look at the actual price tag.
Since the NSE isn't public yet, shares are currently trading over-the-counter in the unlisted market. Recently, they've been hovering around 2,250 rupees. Now, keep in mind, this price was adjusted downward a bit recently because of a 4-for-1 bonus share announcement, which basically increased the total number of shares and made them more accessible. But what's really fascinating is that some analysts peg its fair value much, much higher, closer to 4,000 rupees, based on its robust earnings per share and overall sector multiples.
Let's contextualize that valuation for a second. When we compare price to earnings multiples, the NSE actually appears somewhat undervalued relative to its smaller domestic competitors. While the BSE has an estimated PE ratio of around 77.5 and the MCX is way up at 165, the NSE is currently sitting in the 36 to 50 range. This is despite the NSE having that vastly superior 93% market share we just talked about. Kinda wild, right? However, if you're looking to actually invest in the upcoming IPO, it is absolutely vital to understand the mechanics of the issue. This IPO is structured as a 100% offer for sale, or an OFS. That means existing institutional shareholders like SBI Capital are basically cashing out parts of their stakes. Literally zero fresh capital from this IPO will go toward the exchange's actual operations. Oh, and here's a fun regulatory quirk. Due to symmetry rules in India, an exchange cannot list on itself, meaning the NSE will have to list exclusively on its primary competitor, the BSE.
Finally, Section 5, Risks and Reality Check. As with any explainer, we really need to ground all this hype in reality.
No investment is without its headwinds, right? And the biggest vulnerability here is definitely concentration. Roughly 80% of the NSC's operating revenue relies directly on trading volumes, which are heavily driven by equity index options. This means if regulators tighten the rules, say by raising minimum lot sizes or increasing margin requirements to curb retail speculation, trading volumes could plummet, and that would compress core earnings really rapidly. Plus, a prolonged economic slowdown or a bear market naturally reduces market participation. And hey, if you're buying in the pre-IPO unlisted market right now, you also face severe illiquidity and some pretty wild pricing volatility.
So what does this all mean? What's the ultimate takeaway here? Well, taking a stake in a stock exchange is best viewed as a structural allocation. It's tied to the long-term expansion of India's financial literacy and rising corporate capital needs. Yes, it's an asset-light, highly profitable machine, but it really shouldn't be viewed as a short-term tactical trade just to chase listing day sentiment.
So I'll leave you with this to ponder. As millions of new DMAT accounts open every single year and as a massive population transitions from physical savings into financial assets, is trying to pick individual winning stocks really the best strategy? Or is buying the marketplace itself the smartest play on the board? Thanks so much for joining me for this explainer, and as always, keep learning.